Welcome back to Strongman Personal Finance. We got a sponsored video today. If you want a sponsored video, you send me $50 to the pinned comment below, and I'll make a video about whatever topic you want. I don't do stock price predictions. In this video, we're going to talk about the Simplify Volatility Premium ETF, ticker symbol SVOL, which seeks to provide investment results before very high fees and expenses that correspond to approximately 1/5 to 3/10 the inverse of the performance of the SVOL Volatility Index Short-Term Futures Index. What the hell did I just read? Okay. So, in essence, this is one of those income funds. You know, you buy this thing and it spits out income periodically. And it's amazing because you can generate passive income, apparently, and be happy and delicious forever. Now, if we go down and we look at some things, we're going to look at a video from the fund manager. Because somebody wanted me to do that, and they compensated me for it. The gross expense ratio is 1.16%, okay? Let me just say right out front that is criminal. I don't know if they have like a net expense ratio. Maybe they like reduce it. No, they don't. Okay, 1.16%. That is an obnoxiously high expense ratio for the illusion of income. Now, we have the fund performance. Okay, they have a one-year performance of 14%. Blah, 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 blah. But I highly doubt this is going to beat the S&P 500 over the long run. I could be wrong, okay? What do they hold in this? Well, they have a bunch of, I don't know, it looks like an aggregate bond ETF, stable income. It looks like they have a bunch of cash equivalents. That's what a lot of these ETFs do. And then they trade these futures with the rest of it, okay? Then they have T-bills. So what you're going to see is periodic distributions from this fund. I don't know if is it monthly? What is it? What is it doing? Does it pay out monthly? I don't freaking know. We'll see in a second. I think it does. But what you're going to see is periodic interest or periodic distributions from the fund. Never confuse a distribution for a dividend. A dividend comes from the accumulated earnings and profits of a business. A business makes a profit. That means they generate more revenue than expenses on the accrual basis of accounting. That gets credited to retained earnings when you close the books at the end of the accounting period. And that gets reduced by a dividend. Dividends come from profits. If a company sends you cash, it doesn't necessarily mean it's from profits. Never, ever confuse a distribution for a dividend. I hate when people just say everything's a dividend. It's not. You need to look at the tax information, okay? Let's look at the distributions. So the first thing I notice about this fund, so we got a couple things here. We have the X date, we have the record date paid. These are all, applicable dates to concerning when you get the dividend, if you're entitled to the dividend, etc. We see here very interesting things that you need to pay attention to. We have the total distribution on the far right. So I guess for every share of SVOL, you're getting 30 cents every single month, it looks like. 30 cents every month you're going to get paid by SVOL. What is composed? Remember I said, this is not a dividend. What is composed of this dividend, this distribution? Well, 26 cents out of the 30 cents is return of capital. Return of capital is giving you money back. It is paying out from the entity more capital than was earned in net investment income. That's what it is. You're basically getting your own money back, and what that does is it reduces the cost basis of your shares. So when you sell the shares in the future, you have a higher capital gain or a lower capital loss. It's a deferred tax event, okay? But in essence, it's giving you your money back. You invest $10, they give you back $5 the next day without making any money. That's return of capital. Your real investment, your net investment is $5. Does that make sense? Probably not, but okay. Long-term capital gains, which are basically none, and short-term capital gains. And then we have ordinary income. So the most recent distribution, I know it's tiny. I'm sorry, like your pee-pee. The most recent distribution was roughly 4 cents of the 30 cents, so just over 10%. Of the distribution came from ordinary income. This is probably mostly the bonds, okay? Because remember, SVOL has these bonds that they're holding. I don't know exactly what they're doing with. I don't deal with the. As a normal person, I don't give a rat's you know what about the 1/5 to 3/10 inverse SVOL volatility index. Okay, waste your time to even think about that. But what I do know is that they hold a lot of treasuries. Okay, and when you hold treasuries, treasuries pay you interest, and that interest is accounted for as ordinary income. That's like basically stable income. So they're doing whatever they're doing with the VIX. And then on top of that, they're generating ordinary income. Now, what do you notice? Okay, let's go back to the very beginning. So this thing started trading in 2021. The first distribution was 25 cents. Okay? They paid out 25 cents, all of which, you can't see it here, but this column is ordinary income. All of which was ordinary income. And we see the trend, ordinary income, ordinary income, ordinary income. So basically every payment was ordinary income, which was from profits that they had made. Net investment income, realized capital gains, that means you sold a stock, dividends, interest, those are all components of net investment or ordinary income. And you can see none of it's from capital gains. Nothing is from capital gains. And we see over time that the distributions are starting to drop, but at least it all came from profit and loss, which is totally fine. No objections. And then all of a sudden in September, something interesting happened. They kept their distributions the same, so they're still paying 30 cents. But now the vast majority of it is return of capital. They're giving you your own money back instead of from net investment income. Now, we're going to watch this video briefly. I don't know if I buy what the guy's saying. But never forget, return of capital, very simply, is giving you your money back. And what concerns me about this fund is that most of the distributions are not ordinary income. Most of them are return of capital. And the guy's like, oh, it's because of tax classifications. I mean, I don't know, maybe. But at the end of the day, ordinary income is the money you're making. Your realized gains or losses, your interest, your dividends. That's the profit that you're making. And if you're paying people return of capital, over time that degrades the amount of money in the fund on what you can use to generate profit and loss. And you're creating the illusion of income. Because all anybody sees, you investing geniuses, all you see is this. This is not a dividend. This is a distribution of which there are components, ordinary income and return of capital. So let's listen to some of the fund manager here. Update, return of capital and fees, quote. This has a over 1% expense ratio. I'm just going to put that out there. On the channel, Armchair Income. Oh my God. Total return, people.
Since launching in May of 2021, SVOL has been quietly kicking up. It's been outperforming the S&P 500 for total returns, and it distributes a consistent monthly income that's currently yielding over 16%. I've owned it since April of 2023, and so far, so good. I've been very happy with it. But recently, I've noticed some misinformation that's been circulating, and today...
Let's read this. Simplifies changes to dividend distribution to primary return of capital, indicating a struggle to meet consistent income targets. I have the same suspicions here. That's exactly what I see when I read that. Just personally. I mean, maybe I'm crazy. I don't know.
Today, I want to address that. So I've invited Larry Kim from Simplify to join us. Welcome, Larry. It's great to be here. Thank you. So as I mentioned, two things I want to address. The first one is return of capital. And you began distributing return of capital in 2023. Were you returning the investor funds back to the investors, or was it actually a tax treatment?
Most of the return of capital that we saw was due to the accounting treatment involved with VIX futures. Some of the distributions would have been classified as return of capital regardless of how much the fund actually earned.
Return of capital is a fairly confusing term. It can be destructive.
Okay, so I guess the implication is that it's some kind of accounting classification. Well, if the accounting classification is masking income, I don't like that accounting classification. That makes no freaking sense to me that you could, generate or use your returns from your futures and make it return of capital and classify it as return of capital. That makes no freaking sense whatsoever. But he's also said, regardless, some of the treatment would have been return of capital, which tells me that they're making less than the freaking income that they're paying. SVOL can beat the S&P 500 and still not meet its income targets. If the S&P 500 goes up 10% and SVOL goes up 12 or makes total returns of 12%, but they're paying a 16% yield, they're paying more than they're making. Okay, so it's irrelevant if they're beating the S&P 500, which is past performance, oh, by the way, and I wonder if that's net of fees. So keep that in mind.
to NAV or not. But I should point out that Simplify is not the only fund that distributes return of capital with that tax treatment. There's NEOS, there's Global X, Eaton Vance. It's not a new thing. But you mentioned that the majority is tax treatment. And then some of it would be a shortfall for a given month, because I've noticed that the distributions look almost exactly the same every month. I take it that's not a coincidence.
SVOL's distributions are managed. So we set the distribution amount equal to the fund's expected long-term carry, which is the income from the fixed income portion of the portfolio, plus the income earned from the core VIX future strategy. We keep the distributions relatively stable and don't make big changes from month to month to make it simpler for investors to plan their cash flow and, frankly, to make it easier for them to understand the product. So,
okay, sorry for my coughing. I'm dying here. So if I understand it, what he's saying is they're doing like, they have this expected return that they're going to make. We're going to make X percent. And some months they might not do as well. Some months they might do better. But overall, their plan is to just pay a flat amount over time. And because of that, they keep the distribution, consistent, regardless of earnings and months, because it'll smooth over time. So the implied future return of this, so if I bought one share of the SVOL ETF, it would be $22.54. So if we take 30 cents times 12 divided by 22.54 was it? The implied future, a forward yield, is 16%. I don't know about you. That seems kind of high. Okay? I wouldn't project my fund to make 16% returns. Unless I was a clown. But that's what according to what I'm looking at, that's the implied forward yield. If I bought one share of SVOL, I get a 16% return, assuming 30% smoothed out distributions. Okay? Well, that's funny because now your ordinary income has consistently been dropping relative to your return of capital. Maybe you're having a bad couple of months. I don't know. Can you show us financial statements?
So in some months, the fund will pay out more than it actually earned, but in other months, it will pay out less than it actually earned. Over time, the goal is for the distributions to closely match the actual carry.
The amount of return of capital for this fund, SVOL, is fairly high. So when you have those months where it's a little bit short, you could actually do the return of investor funds, as many funds do. But if we look back on 2023, would it be fair to say that the vast majority of the distributions that were classified as return of capital were actually the tax treatment?
Yes, that's correct. Most of it was due to the tax treatment.
Okay. But you can't classify 100% as return of capital.
Most of it. How much? 50.1%?
Well, and that's because of what? Are there different portions of the fund that get treated differently?
Well, the first thing is it's important to understand that Simplify is not attempting to generate return of capital or manage taxes in any way. The classification of distributions is just a byproduct of the required operational and accounting rules. But in general...
And those rules are made with a logic, okay? I trust the accounting rules, maybe because I'm an accountant.
The return of capital that you've seen usually is a result of the VIX futures part of the portfolio.
Right, and the fixed income portion, that also generates some...
So are you not making enough on the VIX futures to support a full distribution as 100% ordinary income? I'm just like I feel like something's being hidden here or not being fully fleshed out. I would have to look at the financial statements to see if they're actually like making money. Are they actually making enough money to consistently generate 16% returns in order to sustainably continue that distribution? I would say no. I don't think most people could do that.
Income, but that income would be treated as ordinary income.
That's correct.
And I've seen people react to different return of capital numbers that you post on your website. Are those numbers that appear month to month estimates or the actual final accurate number?
Investors should always use the tax forms they get from their broker-dealer.
That is 100% true. At the end of the year, at least in America, you get a 1099, whatever. You get a 1099 tax, a consolidated 1099 usually from your broker. Use those numbers for your taxes because that is the official freaking numbers that are reported to the IRS. That is true. But the numbers on there usually are an indicator. But yes, you don't go to the website and use those numbers to figure out what your freaking income and non-dividend distributions are. Your tax forms will actually tell you the real answer at the end. But that's true.
And to be honest, some broker-dealers interpret the financials differently from others. The numbers that we report on the website are estimates mainly used for planning purposes.
So if on the first of the month, or whatever day of the month, you see zero return of capital, for example, that doesn't mean anything necessarily. It could change a couple of weeks later.
It could.
And when you launched the fund, originally there was no return of capital. So what changed during the life of the fund?
Right. Well, SVOL really is the first of its kind, a fund trading in VIX futures that's classified here in the U.S. as a 1940 Act investment company. Prior to SVOL, other products of its type were either exchange-traded notes, which are essentially bank obligations, or they were some type of traded partnership. We felt it best to come out of the gate with the most conservative interpretation, which is to classify everything as income. Over time, our accountants became more comfortable with declaring a portion of the distributions as return of capital. But please remember that return of capital is not an objective of the fund. Investors shouldn't plan on it, but just should consider it a happy bonus if it happens.
Yes, because they didn't make enough money in the current month to meet the distribution. And if you see that more and more and more of each distribution is return of capital, that's concerning to me, even though I don't own this and I never will.
See, and that's why you don't promote it in your marketing materials. It's an outcome, not an objective.
That's correct.
Hypothetically, if an ETF was distributing a lot of investor funds back to the investors over a long period of time, what would be an obvious indicator of that?
The most important indicator for SVOL, or for any funds for that matter, will always be total return. Total return is the
ding, 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 ding.
Truth serum of the investment world. It reveals all.
At stockcharts.com,
total return is all that matters. That's why I don't like these stupid income funds.
A fund has a 12% yield, which sounds great, but a 10-year average annual return of 1%.
Yeah, exactly.
Total return, reveals the truth, right? So if a fund does not have an attractive total return over time, then all the distributions in the world and how they're classified simply don't matter.
I see. Well,
you know why I think this beat the S&P 500? If this came out like in whatever, when did this come out? Late 2020. So we had that huge crash in 2022. And they were probably in treasuries and VIX futures, inverse VIX futures. They probably, benefited from holding treasuries while stocks were crashing. And then maybe these VIX futures just happened to do well during that time period. That's honestly what I think might have happened. Now that I think about it. And once the bull market comes back, this all of a sudden turns around. Maybe I'm crazy. I don't know.
Current yield is a bit over 16% as we record this, and that's been somewhat typical for the fund.
Oh, look, I calculated that perfectly. Damn, I'm a genius.
The total return for the year 2023, and it was just under 20%. So that would mean, because the total return was higher than the yield, that the net asset value actually increased, and you obviously weren't, at least for the majority of situations, returning investors' funds back to them.
Yes, that's correct. Just keep an eye on total return over time. And by that, I mean years, not months. SVOL, like any equity-based fund, will have down years as well as up years. But just keep an eye on the return.
That's simple.
Okay. I mean, I'm not saying he's lying or doing anything weird, but I don't like this at all. I don't like this. I don't like the implied 16% return. That's BS, number one. And then number two, the vast majority of return to capital it's never a good thing because it's creating the illusion that you're getting a dividend when you're freaking not. And on top of that, you're paying a 1% freaking expense ratio. Anyway, this has been a sponsored video. If you want a sponsored video, see the pinned comment below. Don't forget to hit like and subscribe. If you want a one-on-one tutoring session, it's $50. Please pay me money. Pinned comment below. Actually, $75 an hour. And check out my book, Stop Being a Broke Loser. It's on Amazon. Cheers.